introduction has been given by sir, but let me tell again all our investors that Mr. Gajendra Kothari is a very senior person as far as managing wealth for the retail investors, and he has guided several people for handling their portfolios, and his speech, today's speech, will guide us how to invest or how to keep our money safe in the trying time like today we are going right now. So over to Mr. Rajendra Kothari. Please start your presentation. Thank you very much.
Thank you so much, Ajit sir. In fact, you've been a veteran in this field, and we are just trying to kind of learn from you based on your experience, Vasudevan sir's experience. So thank you for giving me an opportunity, Bombay Stock Exchange Investor Protection Fund, as well as CDSL IPF. It's a great honor for me to be doing this second presentation with the investors in these trying times, tough times. So without further ado, let me just start off my presentation. I hope you can see my screen and you're able to hear me properly. So with that, let's begin. So the first thing which I want, so as I said, these are challenging times for all of us. Never in our history we have seen such kind of a scenario where for more than a month we are all locked down in our houses. We have no idea when this lockdown is going to get lifted, when businesses are going to be normal, and hence it's very unprecedented times. But life must go on, the show must go on. As Mr. Vasudevan mentioned earlier, we used to do a lot of physical seminars where more than 400, 500 people used to come to these seminars. But now no longer we are allowed to meet. We have to practice social distancing. And because we are locked down, we have to start applying new things and, continue innovate. So I always begin my seminar with this very important quote from Benjamin Franklin, that an investment in knowledge pays the best interest. And that is why I would like to thank all of the 170 participants who are logged in into the system right now who are watching this webinar. You decided to invest this time of yours in knowledge. And I'm sure this experience, this time of yours, this effort of yours would not go waste. This, as Mr. Benjamin Franklin has always says, this investment will always give you 100x or 1,000 times more returns than what you have really invested. And as another my favorite author, Rich Dad Poor Dad book author Robert Kiyosaki, he always says one of the reasons the poor are poor is because they do not invest money or time into their financial education. So friends, while this session may be free for you as far as money is concerned, and because as Mr. Vasudevan mentioned, this is from the Investor Protection Fund. Basically, this is investors' money which is being invested into doing such kind of events. But your time is not free. Your time is precious, and still you have decided to invest this time. So I'm really grateful to you for this. How to build a robust portfolio in challenging times like this? All of us are wondering this important question that markets are going down, our portfolios are going down. What is a safe investment right now at this hour, and what all things we should be knowing about it before we start putting our hard-earned money. Today I'm going to share some of my learnings and experiences with you. So I urge all retail investors out there, when you go out and invest into the markets, just don't do this ad hoc, on an ad hoc basis. Have a proper plan. Okay, unless you have a proper plan, you don't know where you're going. So a financial plan guides you how to put your hard-earned money and in which places. So you have to begin with protection, which means you have to first make sure that you are safe, and if something were to happen to you tomorrow, you have adequate protection for the family. So if you're a breadwinner of the family, so you need to have a term insurance, okay, in which something happens to you tomorrow, your family, your wife, children gets the money. So if you are the person who's the breadwinner in the family and people are dependent on you, please go and get term insurance. There are many online term insurances there. You can go and buy any one. The second thing, of course, you should have is health insurance. Once you've taken term insurance, the next priority should be to make sure that all your family members are covered in a health insurance, which means if something, again, casualty were to happen in the form of like, COVID-19 case, if you test COVID positive and if you have to be hospitalized for a month or two, you don't have to dip in from your financial savings, and your health insurance can come into play. So these are the two most important protection covers you must have before even you start your first rupee into, invest first rupee into markets. After that, I would strongly recommend that have you built your emergency savings. Again, this lockdown would have given a classic thing for us to, for the first time, people have realized the importance of emergency fund. Otherwise, you thought life was all good. Emergency was never an emergency. But now, since last month, most of us have, our businesses are closed. We have no income coming in. So how do we make sure that our expenses are able to met? That is why we request investors to have at least 6 months to 12 months of their monthly expenses safe, invested in a safe asset like either a FT, fixed deposit, or a liquid fund, where whenever you want, you can take your money out for emergency requirements. You may require it for hospitalization or any other purpose. So emergency fund will really help you. Please take this advice seriously. Again, before starting any long-term investment, this should be taken care of. Then comes your near-term goals requirements. You might have your children's going into colleges and schools, and hence you may need to pay fees in the months to come. So again, if your businesses are not running, so these things like school fees, EMIs, all these things will continue to go from your account, and that is why again, some part of money should be kept aside again in a kind of liquid fund or FT for the short-term goals. Once you've done this saving part of it, that is when you can think about the long-term goals. And even in long-term goals, I have written the first goal being retirement planning. This is the most important long-term goal of yours. This is the largest long-term goal anybody can have. And in this lockdown, many cases I've now seen, on the net, that most people are finding it difficult to pay for even 21 days of expenses. The month when the first lockdown was there for 21 days, many people found it difficult to survive with no income. So imagine if 21 days were finding it difficult, how would you live 21 years of your life in retirement if you have not built your retirement purpose? This is an important trailer of the movie to come, which life has shown you. So please wake up right now, start your retirement savings, and I'll tell you how to build your retirement fund, subsequently. And then again, the bigger ticket item comes like children education. Many of us want to plan for child's higher education in India or foreign, and how to plan for that. And then each one of us also want to buy a dream house. So again, how to plan to buy a dream house. So this should be the plan to put. Once you've done the plan, then the idea is, where should I put my money? Now, before you put the money, you have to understand what kind of risk profiling you have. Okay. Now, each of the 170 people who are now logged in, you don't all will have the same risk profile. There are few people who can take very high risk. There are few people who don't want to take high risk. There are young people who have longer time frame. They may want to put money in risky assets, while there may be older people who want to preserve the capital and they want to put in safer assets. So each one of us will have different risk profile. Each one of us need to understand the risk profile, what we need to take. So first is to know how much risk do you need to take in order to satisfy your goals. So suppose if you go from Mumbai to Pune and the distance is 180 kilometers, and we all know that, our car, the average speed would be 45 kilometers we need to go. So we know that if you have to reach Pune in 4 hours, we need to drive at 45 kilometers per hour. If we need to reach the Pune in 3 hours, then we need to drive at 60 kilometers per hour. And for some important and emergency reason, if we need to reach the Pune in 2 hours time frames, then we need to drive at a very high speed of 90 kilometers per hour. That is the risk required. So you have to know how long is your time frame for goals and how much capital you have. Once you've known the need for risk required, then comes whether do you have affordability or not. Okay, so can you take the risk? Again, if the people are rich already and they have a lot of assets, and they can take some part of the risk with the equity money, equity capital. So for instance, if tomorrow the markets are down 50%, they don't have to worry because they have other assets like real estate, fixed deposits, and other funds in other areas. So that is the affordability part. But if you don't have any money and if you're putting all your money in equity, then you have to understand whether do you have the affordability to take risk capacity or not. Finally, you may have the affordability and you may need to take the risk, but do you want to take the risk? So some people I've seen, even if they need to take the risk and they can afford it, but they still don't want to. Who are these people? These people are the ones who have just started in the career maybe, and you know, they're very happy with fixed deposits. So, you know, anything which goes down, like if 100 rupees become 95, it gives them sleepless nights. Okay, so that is the risk tolerance. If you know, if emotionally you're not going to take risk, that shows you have low risk appetite again. So, and before venturing into stock market, you know, as Adam Smith mentioned once, if you don't know who you are in terms of the risk profile, the stock market is an expensive place to find out. I'm sure you all agree that, you know, if you have not done your research, and if you just jump into stock market without knowing and starts buying penny stocks and risky stocks, then it's a very expensive way, because by the time you realize who you are, half of your money would have gone. So always remember this before starting. Once you've done risk profiling of yourself, then you need to find out where all you should put money. Again, I would not recommend investors to put all their money in one place. They should diversify, and that is what it is called asset allocation. If you see the left hand side of the chart, that is the wellness thali. Why our meal consists of so many items like rice, chapati, bread, fruits, vegetables, high fat foods, milk, dairy, eggs, fish, etc. Because all this have a place, all this have a role in our thali. It gives us a balanced meal, and everything is necessary to live healthy, right? So to live wealthy, again, our assets need to be diversified. Then you have the wealth thali on the right. So you should have your assets divided into stocks, bonds, which is like FD, safe, real estate, and cash. Even cash is also an asset class. The money lying in savings account right now, which is earning you 4%, is also an asset class today, right? Because in these times, cash is king, as people say. So if stock markets are down 50%, and if you have cash today, imagine you can buy the same stuff at 50% down. So this is broadly the asset allocation which one needs to maintain. As you know, people have always said, don't put your eggs in one basket. So you should not put all your money in one asset class. You should diversify, so that if something goes up and something goes down, you don't have to worry. Now, how do you decide what asset class is right for you, or how much to put in each asset classes? So internationally, you have many of these asset allocation models which are there. So very simple for retail investors. If you see on the left hand side, you're a very conservative investor. You don't want to take much risk. Okay, you're new to investments. So you can begin with, like, 20% invested in stocks, 55% in bonds or fixed deposits, and 25% in cash for your emergency requirements. As you graduate towards the right hand side, then you start becoming moderate conservative, then you become moderate, and then you start becoming aggressive, and finally you are very aggressive. So on the right hand side, you start with 80% stocks, 15% bonds, and 5% cash. My suggestion to all investors is start from left always, and gradually starts going towards right. I've seen many young people starting right from right, and then once they burn their fingers, then they leave stock market and says, I don't want to come to this ever again. This is a most important mistake we all made, and that is why I want to share my learning with you. I'm sure most of you know the difference between debt and equity. Just quickly, I can tell you, debt is like fixed deposits. You invest in fixed deposit for a fixed period. You earn interest every quarter, every month, or maybe every yearly, and it is for a fixed tenure, like 5 years, 6 years, 7 years. And at the end of the tenure, you get back your principal amount. Equity, on the other hand, is forever. There is no time frame as such. You don't earn interest, you get dividends, and you only make dividends when the company makes profits and company declares dividends. And also the value of equity can go up and down based on the perception in the market of that company. So it may appreciate or it may depreciate over time. One thing we should all realize, friends, is who should go for debt and who should go for equity. Conservative people should go for debt, and aggressive people who want to grow their capital can go for equity. Somebody who want regular income, like senior citizens, for them debt is more suitable. Somebody younger person who wants to grow their capital over a long period of time, equity is a more suitable option. In fact, you can have mix of two, as we just saw in this slide, that you can have a balance profile also. That is how you should divide your portfolio. So now, if you were to ask me, what are the options available in debt today? So the most important options, friend, is the bank fixed deposits, which is the most popular. And then apart from bank fixed deposits, you have many other of these small savings schemes promoted by Government of India or post office. You can see senior citizen savings scheme, PPF is there, employees provident fund, which you all would be getting from your companies, is a debt fund. Kisan Vikas Patra, etc., etc. But one thing, the most important thing, which is bank FD, I just want to take a minute here to understand what is the real return in bank FD. See, normally, so if you see the 1 year bank FD today, it is giving you around 5.7% in SBI. Now, just want to understand from you, is this the money do we take home when we invest in 1 year bank FD? 5.7%. Many people think that this is the amount I take home. Not necessarily this is the amount you take home, because if you are in the higher tax brackets, you have to pay tax to the government of India. Assuming if you are in 30% tax bracket and you have to pay 30% on 5.7%, so barely you are left with 4%. 4% is your net home income. And then you have to minus inflation also, friends. Every year, even in this lockdown, inflation is there, right? Inflation has not gone away. So for most of the people in country, the inflation is somewhere between 5 to 7%. Okay, for middle class and for upper middle class. If inflation is between 5 to 7% and your FD is giving you 4% post-tax, then you're not making positive returns. You're actually making negative real returns. This is something what you should be aware of. Any investments which you do, at the end of the day, you should make positive real returns, which means after tax and after inflation, that return should be positive. Remember that this. Then the people ask me other question. Then if fixed deposit is not that safe, I'm not saying it's not safe, but at the end of the day, it can be risky too, because if your goal is quite big and if you don't have much time, and if you go at a very snail pace, thinking that I'll put my money in FD and be safe, you perhaps may not be able to achieve your goal. That is what something you need to be aware of. Again, in these times, people are talking about gold as a very good option because everything else is going down, but gold has gone up sharply in the last 1 year. So most people who don't know, last 1 year gold has appreciated by more than 50%. Yes, you've heard it right, 50% appreciation over the last 1 year. Doesn't mean that now you should straight away jump into gold, because if last 1 year is 50%, doesn't mean that next year it will also be 50%. It may be possible, it may not be possible. This is the long-term history of gold prices for the last 95 years. And I would suggest, yes, you should have some allocation in gold, not because it has gone up by 50% in last 1 year, that is why you should have, but because it's a part of broader diversification. How much percentage you should have in gold? Normally, experts say between 5 to 10% or 5 to 15% of your money should be in gold. You may require this for your children's marriage purpose, or this can be a good hedge also in these times. There are many ways to buy gold. You can buy gold physically, which of course in this lockdown is not possible, and I would not recommend that as an option also if you are buying purely from investment point of view. If you're buying from consumption point of view, yes, it makes sense. Then you can trade on commodity exchange. You can buy gold on the commodity markets. Gold ETF is another way. If you have demat account, you can buy gold ETF into your demat account. As Ajit Manjuri sir mentioned that now all asset classes can be held in the demat account. So directly you can buy gold ETF from any of your broker into the demat account. There is another way you can buy gold. If you don't have a demat account, you can buy gold mutual fund through almost all mutual fund houses. Of course, the charges will be little more expensive than gold ETF because it will be a double layer, because the gold fund themselves invest in gold ETF. But so if you're wanting to buy gold for short-term point of view, 1 year, 2 year, 3 year, then any of these three options may make sense. The best option I would still suggest is gold ETF. But if you're buying gold from long-term point of view, then I would recommend go for sovereign gold bonds, which are issued by Government of India, and you can buy actual gold in paper form by them. It is completely safe. All of us can buy, like individuals, HUFs, trust, everybody can buy. Even you can make application in the name of minor also. So if you have young children, you want to buy for their marriage, and you want to make the investments in their name, you can buy. Remember, per annum you can buy a maximum of 4 kilograms of gold, which again I think it's a good quantity. Nobody would really like to buy more than that. The best part about investment in sovereign gold bonds is you earn 2.5% interest also from Government of India, which is amazing. And you are not paying any charges when you buy there. And the usual tenure of these bond is 8 years. So that's why you need to have a long-term view. At least 5 years you must have, and after 5 years you can still sell. Early redemption is allowed. The best part about these bonds is, friends, you can buy in your demat account again through BSE Star MF platform. Also, you can buy sovereign gold bonds and you can put in your demat account. Or if you want to buy in physical form also, if you don't have a demat account, even that is also possible. So you can make some allocation in gold from diversification point of view. Then the most important other asset class which comes is equities. And the markets, what we have been seeing over the last 2 months has been very volatile. In the month of March, we saw markets crashing down to 26,000 Sensex. But many people who are into the stock market for the first time must be experiencing this catastrophe, as a first time thing. But let me tell you, all those people who have been there into markets for long enough, markets have not, come down like this for the first time. There have been many instances. So, more than 50% fall. There was in the dot-com crash, which happened in 99, 2000. Then in 2007-8, we have seen markets crash by more than 50%. Sensex came from 21,000 to 8,000 also in this crash. And now we are seeing markets coming down all the way to 26,000. And now we are back to 33,000 as we speak today. So this is not new. So these things have happened in the past, and these things will also happen in the future. Only in hindsight we know that, wow, this was a great opportunity. So then why we are really scared? As Warren Buffett has said, unless you can watch your stock holding decline by 50% without becoming panic stricken, you should not be in the stock market. So if you have come to stock market thinking you want to make a lot of money, then be prepared that your money will also go down. It is not only one-way street. It is both ways. And be prepared that even good companies can go down by 50%. Bad companies can go by 90% also. So unless you have the heart and the courage and the stomach to digest this 50% fall, don't come to stock markets. Is a very important advice from Warren Buffett. Now, as I said, markets fell every year. So right from 1990 to 2020, markets have fallen every year. So if whatever was the peak in that year, market has come down from that level of peak to anywhere by 10 to 50%. So if you see in the early years, markets, it was very regular for markets to fall closer to 30% every year or every second year. Markets would come down by 30% of whatever the 52-week high they had made. Only in the last 10 years, people have forgotten that markets are volatile, because hardly once in last 10 years markets have fallen by 25%. That was in 2011. Otherwise, market have just fallen by 10%. And many people think, wow, markets are very less volatile. It's safe. And then you got the very root shock in 2020 when markets fell almost by 38% from the peak. Now, always remember that once in a decade markets will fall by 50%. This is what history tells us. So this is a part of the market cycle. You should not be worried. This is a chart of Sensex. The golden chart is what I say. Sensex has a history of 82 2020. It is 40 years, and in this 40 years it is not one straight line. It has gone ups and downs. And see the boxes here. All these events at that point of time look like this is the end of the world, right? Whether it was terrorist attacks on Mumbai, terrorist attacks on US Twin Towers, Lehman Brothers filing for bankruptcy, assassination of our prime minister, whatever you can say. Every time we thought this is the end of the world, markets would collapse, Sensex would collapse, but markets have rebounded strongly after that. And no wonder in the last 40 years, Sensex has given around 15 to 17% per annum returns, including their dividends. So in the long term, the trajectory will always be up, but it will not be a straight line. It will be always ups and downs. We do remember that. This is the portfolio of Warren Buffett's, the world's most followed investor. Okay. So he has started from the age of 11 and now is almost 90. Look at his portfolio. It is $85 billion right now as we speak. But his $85 billion has again not come in one straight line. In 2007, you could see he was $62 billion and then it crashed all the way to 37. God of stock market, God of investing can't predict what is going to happen in the market tomorrow. Then we are very ordinary retail investors. We have no idea how markets are going to behave. So there's no point timing it. Just remain invested like Warren Buffett has been. And today he's sitting on $85 billion investments. So why retail investors are not able to become like Warren Buffett? The problem is the ticker. The problem is the screen. The problem is the constant price movements we see on Money Control app or any other app. And because we constantly see the prices, if we have invested at 100 rupees and that price becomes 110, we sell and we think we have made money. When you invest in stocks, don't think stocks are just a piece of paper. when you buy stocks, you're actually buying businesses. You're becoming part owner of the business. So if you're buying Reliance Industries, you are a part owner like Mukesh Ambani. Okay. So if you think that way, then you'll be buying for longer term point of view. But if you think that it is only a piece of stock, it is only something you can buy and sell at any point of time, then I don't think you'll make money. And one classic example I would like to give of retail investors, how they behave in stock market is the example of Jet Airways. When there was a problem of Jet Airways and which became public, the retail holding, see the level. December 2017, the retail holding was only 4%, which went up right to 11.5%, because people thought now the stock price has crashed and let me buy it now, and when when Jet Airways double, I'll make money. But see the fund houses, the mutual funds and the foreign investors, what they did, they cut down their positions the moment they knew there was a problem. So we become too greedy. We don't do our research and we blindly follow tips which circulates around, and we buy and then we end up losing money. Another problem which I've seen with retail investors normally is that people buy when the markets are high and people exit when markets are low. Okay, so when Sensex was 42,000, most people want to open demat accounts and want to invest. And when Sensex comes down to 25,000 and below, which is the right time to buy, people don't buy. Okay, so that is a big mistake we do. And so how, as a retail investor, should you learn from this? There's a wonderful approach called traffic light signal approach. As traffic light says, green means go, red means stop. So if Sensex also has a kind of in a way traffic light signal. So if the P ratio, and what is P ratio? A price of the market divided by the earnings of the market. So if the P ratio is higher than 19, then it shows it's a red light. And if it is lower than 16, it shows it's a green light. Okay. Now this, based on the historical figures, this framework has been provided. This has been prepared by IDFC Mutual Fund. This is one of the metrics to see whether markets are expensive or not. This is not the only metric, I must tell you. Okay. So when markets are red, usually you should not invest. You may hold there, but you should not put fresh money, or should be very, you should planning it to put in a monthly basis, and don't put lump sum as much. When markets are in yellow zone, you should be cautious again. But when markets are in green zone, you should go all aggressive. But usually the reverse happens. When markets are red, 63% of the people come and put their money, and when markets are green, only 8% come and put the money. The typical mistake which we make. So whenever you put when the markets were green, when you put when the markets were red, your next 3 years returns were only 2.3% per annum, which is quite bad. And whenever, friends, you put when the markets were green, your next 3 years returns were 21% per annum. A simple mistake which you can avoid by looking at the traffic light. So give your equity investments a green signal. You must be wondering what is the current PE ratio of the Sensex. Well, friends, it is closely right now around 19.88, close to 20 as on yesterday. Today, Sensex has gone up by 1,000 points. So I'm sure this P would also have now become 21 or something like that. Now, of course, it has come back into the red zone right now. So you should be a little cautious and invest in a gradual manner. This data is published on BSE India website. You can go and you can find the P ratios on a daily basis, and you can find historical P ratios also. So in markets hit 26,000 on March 24th, 25th, P ratio came below 16. It was around 15, and that was, imagine, a golden time to buy. So if you bought, say, at P 15 today, in less than a month's time, markets would have given 20% return from those levels. So always, buy low and sell high. The other thing which I want to share with you is, friends, remember, equity markets move like a pendulum, which means just like a pendulum goes from extreme one end to another, markets can also go from one end to another. Though I said markets in the long term gives you 12 to 14% return, but every year either markets will give you 30%, 40% return, or it will give you minus 20%, 30% return. Every year on year, it won't give you flat 12% return. That is why we say the average is 12%. So the average is the middle thing in the pendulum. So right now markets can go below 26,000, 25,000. Markets went high to 42,000 also, but it always come back somewhere, the average return is somewhere in the middle. Great. So many people must be wondering that how should I handle such stock market crashes? This question can be addressed from the perspective of two kind of investors. Now, many of you who are watching this webinar must be existing investors, those who have already invested, and perhaps you might have invested all your money or most of your money in equities. So what you must be wondering, what should I do? So as I said, don't panic. Right now, this pendulum, what you saw, went on the left hand side extremely, and now again it is coming back to right hand side. So as I said, pendulum doesn't stop on the left, extreme left, or it doesn't stop on the extreme right. It comes back. So don't panic, it will come back to normal. So somebody who has invested already should remain invested. If you have more money to invest, then again follow this PE approach. Okay, invest when the markets are low, and stay for long term. For those who are new investors who have not put a single money so far, I must tell you in hindsight, you're lucky because you avoided that crash. But now is a good time to invest. Okay, you can, again, I would not recommend you to put all your money into this market, today only. Do in a gradual manner. So if you have 100 rupees, divide in 4-5 buckets. Every time market goes down by 5 to 7%, you should put that money into market at that point of time. Look, you can never find the bottom, and there's no point getting to that exercise. So invest at all levels. These levels are not bad, and if you hold for next 3, 4, 5 years, I'm sure the returns, the outcome will be very positive. Many of you again may have this question in your mind that how do I invest in markets? Of course, you can invest direct equity stocks if you have the knowledge. Then the other way is to buy Sensex index funds directly through mutual funds, which means if Sensex goes up by 10%, you make 10% return. If Sensex comes down by 10%, you lose 10%. And then the third option, of course, is mutual funds and PMS also. So if you think that I want to make more returns than the markets, and there are good mutual funds and PMS out there who think they can do a better job, you can go. But all I want to say at this stage is invest. You can take any of the 3 routes depending on your risk appetite, depending on your comfort factor. But invest in any of these 3 ways, it will benefit. Who are the people who should invest directly? For all those investors who want to invest directly in stock market, friends, you need to have these 3 things before you put your money. Do you have the interest in putting your money in stock markets? You need to have very deep interest. Secondly, you have a lot of time. Okay, this is not a part-time activity कि 2 मिनट मनी कंट्रोल देखा और हो गया. इसमें बहुत टाइम आपको रिसर्च करना पड़ता है, बैलेंस शीट पढ़ना पड़ता है, कंपनी का सारा बिजनेस को देखना पड़ता है. और फाइनली आपको नॉलेज है कि नहीं है, बैलेंस शीट पढ़ने का नॉलेज है, व्हिच मोस्ट चार्टर्ड अकाउंटेंट्स विल हैव, सीएफएस विल हैव. सो अगर आपके पास वो नॉलेज नहीं है तो फिर आपके लिए मुश्किल है. तो अगर तीनों में से कोई भी चीज आपके पास नहीं है, then it may be very risky to put stocks in your own. Then it is better to go to a professional like a mutual fund, as Vasudevan sir mentioned, that for retail investors, the most ideal way is actually the mutual fund route. Many people may not have invested in mutual funds right now, because in our country, less than 3% of the population so far have invested in mutual funds. And one of the reasons is the financial literacy is very low in our country. So it's for most of you who don't know, in a very simple way I can explain you. Investors, we are all investors with 10,000, 20,000, 50,000 rupees. We don't know how to buy a stock, or we don't know how to navigate the markets. So we can all pull the money and give it to a professional fund manager, that is a mutual fund. That mutual fund will invest in different kinds of securities, and these securities over a period of time will give returns, and these returns will be passed to you as investors. That's simple mutual funds for you. Okay, so this vehicle is meant for the common people. Mutual funds are regulated by SEBI, and the mutual fund industry has been there in India for the last 30-40 years. UTI was the first mutual fund right in 1964. So in a way, we have 50 years, more than 50 years of history of mutual funds, and it is meant for retail investors. Now, you must be thinking that how as retail investors I can go and buy directly on mutual fund. So you can go, now SEBI has allowed to buy mutual fund from the stock exchange also. So you can buy directly from BSE Star MF, online. Or if your agent or advisor is there, mutual fund distributor is there, you can buy through them also. If you have a stock broker, you can buy through your stock broker also. So there are many ways you can buy. Again, you have the option, you can keep all your mutual funds in Demat account, which is the ideal way now going forward, because all your asset classes will be in one Demat account. You don't have to worry. And every month you get this consolidated account statement, so you can see what all funds are there in your account. So that is definitely the more convenient way to go and buy mutual funds. Many people again has a misconception that mutual funds invest money only in stocks. That's a wrong notion. Mutual fund is a vehicle. That vehicle can invest in stocks. That vehicle can invest in bonds, gold, currencies, any other commodities. So not necessarily it is only stocks. Okay. So as I mentioned, mutual funds comes in different form of risks and return. On the left hand side of the screen, you have low risk, low return mutual funds. So if you put your money in money market funds, your money is safe and you can get around 6% return, 5 to 6% return from these investments. And on the extreme right hand side, you have high risk and high return, which are sector mutual funds. There you can expect around 14-15% return over longer term, but you are taking high risk. So right now in the recent market, when markets fell down by 30%, even those mutual funds would have fell down by 30-40%. So right from low risk like 6% to 12, 13, 14%, you have entire spectrum. In the middle, if you want to be balanced, so go for moderate risk and return. You can go for balanced fund where it can be like 50 equity and 50 debt, and you can expect a return of around 9 to 10%. So based on your risk profile, based on your time frame, you can invest in different categories of mutual funds. Many people would have this very important question must be going into the mind, that which funds to go for. So I've laid down a very simple example, that if you're first time into mutual funds, start with liquid funds. Okay. Or remember I mentioned you that you can put your emergency funds into liquid funds. So liquid funds are very safe that way. But one thing I must want to caution you, that no mutual funds can give you guaranteed returns. Okay. Unlike bank fixed deposits, no mutual funds are allowed to give guaranteed returns, and that is by SEBI. So if somebody promises you that you can get guaranteed returns, he or she is simply lying to you. So you can start with liquid funds where it is safe. Your money is not invested in equities. You can expect around 5-6% return in liquid funds. You can put for a month, 2 months, 3 months, 6 months also. If you are a person who are not very happy with bank FDs and are into higher tax brackets, want to have a safer option compared to bank FDs, then you can go for something like banking and BSE debt funds or corporate bond funds where your money is going to AAA companies. And at this point, I also would like to bring this Franklin Templeton issue, because Franklin Templeton issue was also about debt funds, and there are 6 schemes closed recently, and many people were worried that is the money safe. So Franklin Templeton invested these money in corporate bonds only, but these were little illiquid bonds, okay, or not very high quality bonds. And right now, the liquidity was very tight because of this COVID-19 scenario, and they were not finding buyers to sell these bonds. So when investors came for their money, came asking for their money, they could not liquidate these bonds in the market, and as a result, they had to go for winding up of the 6 schemes. What does this mean? This doesn't mean that your capital is lost or your entire capital is lost. This only means that right now there is a freeze on any purchase and redemption. So for next 2.5 years, we cannot withdraw our money. So whatever portfolio these schemes had, as and when the portfolio, the company gets money from these portfolio companies, okay, where they have lent with the interest, every month on a month-on-month basis, they would keep giving you back your money. So at the end of 2.5 years, you may realize your entire money back, or there may be a scenario where the entire money may not come, maybe 90% can come or 80% can come. We don't know as of now, but we believe that most of the money should come, and if we are lucky, even 100% of the money can come. So even in debt funds, there are many categories of debt funds. They're very safe and very risky funds. I would normally say when you're going in debt funds, go for safety. Don't go for risk. If you anyway want to take risk, why not take a risk in equity funds or equity markets? Don't take risk in debt funds. The other category you can go for is balanced advantage funds, which is a very right vehicle for most retail investors. What do balanced advantage funds do? They put your money into equities and debt based on the valuation of the market. As markets go down, the equity component goes up. As markets go up, the equity component goes down. So they automatically balance your portfolio, which means you can buy and forget in these funds, okay? And you will do quite well. You don't have to worry, and the volatility will be less in these funds compared to pure equity funds. Of course, if you are a very high risk investor and want to put your money all in equities, then I would recommend you to go for large and mid cap funds, okay, where you have a mix of large and mid cap, or you can go for multi cap funds where your money is invested into small companies, mid companies, and large companies in whatever proportion the fund manager thinks is the right proportion at this time. You can also go for selective international funds also. So now most people, experts, are talking about international diversification as well. They're saying that why just invest in Indian stock market? Now you can buy American stock markets, European. So you can diversify beyond India also. So 10, 15, 20% of your portfolio can go into international equity. Again, I'm talking about purely from diversification point of view. Don't buy into international markets because last year international markets did very well and Indian markets didn't do very well. That should not be the reason. From a long-term diversification, that's a good idea. Avoid sector funds. Don't go for sector funds because sector funds can be pretty risky. I would strongly recommend not to go for them for the retail investors. 10 minutes more and we'll take questions. And then, so I just want to quickly tell you that even the most high-profile investors like Ramdev Agarwal, from Motilal Oswal, who has been in Indian equity markets for the last 30 years. Look at the various. This is his journey, and there were 3 occasions when he has lost more than 50% capital. Okay, first in 1992, 93, then in 2000, 2003, then 2008, 2009, and even now. We had a conference call with him recently, and he said, as we speak today, his portfolio is down 25%. So 400 crores down from this. So even he can't time the market. So again, want to just remind young, the retail investors out there, nobody can time the market. But if you stay longer for 30 years, look at what kind of per annum returns he has made. Of course, we can't copy him. We can't make this kind of return. But if we make even 10, 12% returns for a long term, I think that will be quite a fantastic job. So for me, he's my mentor, and I really decided to follow him. And I said, look, can I make 100 crores portfolio, in 20 years time? So there was a movie called One Idiot, which is there on YouTube for 30 minutes. I would strongly recommend you to watch this movie, One Idiot. That movie changed my life 10 years back. And I decided that I want to follow One Idiot and become One Idiot someday. So, that One Idiot in that movie was worth 50 crores, 100 crores by the age of 50. So if I have to become 100 crores, the strategy was that 4 lakhs I have to invest monthly in an SIP format. And every year I have to increase the SIP by 10%. And if I do for 20 years, assuming I get 15% return, again, friends, I want to give you a disclaimer. This 15% is not guaranteed. This is what I think, I would like from the market. Markets may give or may not give. Okay. So this is my plan. I started with 10,000 SIP in 2010 because I didn't have 4 lakh rupees money, 10 years back to begin with. So I started with 10,000. And every year I kept on increasing my SIP amount, as in when my income used to go up, I increased my SIP. So today my family's SIP money per month is approximately 9 lakhs because I believe in this principle that first you should earn, then you should save away, and then whatever remaining you should spend. That should be the motto, and then only you can become this one idiot in the time to come. Now, how I have planned this SIP, this whatever amount you're seeing, the first and the most important goal is like retirement goal. As I said, this is the most important goal in life. So 30 to 60 you work, and 60 to 90 you enjoy your life. You will only enjoy when at every age, like 31 have you saved for 61, 32 have you saved for 62, because at 62 you will have no income. So you have to save right now when you become older, for the older you. That is how you should think of retirement, and that should be your most important priority. Okay, so when I did this was my retirement SIP, which I started almost 10 years back, 50,000 per month for my retirement goal. And I'm not going to stop this until I achieve my retirement corpus. Okay, that should be our first priority. In that movie, One Idiot, that boy ended up buying a Rolls-Royce car when he was 40 years. And Rolls-Royce is a very dream car for almost all of us. Even in Mumbai roads, you will find it difficult to see this car. The car costs today 8 crores rupees. So I don't have this kind of money today, but I wanted to have a roadmap for Rolls-Royce. And the car cost today is 8 crores. But in next 10 years, 15 years, the car cost would become 16 crores because of inflation. How would I get 16 crores money if I don't plan? And if I want to plan for 15 years, I need to have an SIP of almost 2 lakhs rupees per month to buy that car. So out of this 9 lakh SIP which you are seeing, 2 lakhs is going for Rolls Royce also. Then I have another goal is my children's education. I have 2 children, a son and a daughter. Okay, so I'm doing planning for both of them. And so when my daughter Aditi was born, and this is an example which I want to share with you, just like any parent, I had 3 goals for her. A graduation goal, which today costs 20 lakhs, post-graduation goal, which today costs 30 lakhs, and marriage today costs 50 lakhs. But when she turns 18, this 20 would become 55, post-graduation would become 1 crore, and marriage would become 3 crores, thanks to inflation. How would I get all this money if I don't plan today? And that is when, I wanted to start SIP. So if I plan today, friends, for graduation goal, I have to do 5,000 SIP. For post-graduation goal, I have to do another 5,000, and for marriage goal, I have to do 7,000 SIP. Quite simple to, and it makes you feel comfortable. So when my daughter was born, you can see the name Aditi Kothari in nominee section in the left-hand side. 24 December 2010, she was born. Immediately, I started an SIP in her name, 10,000 SIP. You can see every month, and then there was lump sum investment of 50,000 and 70,000 below. This was the money she received in her naming ceremony from grandparents. Again, I thought this was not my money. Let me not touch this. Because it was her money, I just kept on investing. And apart from that, 10,000 rupees per month has been going for the last 9 years, friends, from 2009-10 to almost now 2020. And I'm very happy to share with you that the portfolio corpus is more than 20 lakhs as we speak today. Okay, so so my daughter has turned 9 years. She has completed 9, and the portfolio has also crossed 20 lakhs. I would have never imagined that I would have this lump sum money at one day, but it was possible because I was doing like SIP of 10,000 per month. So my request to all of you is that focus on goals and not markets. Markets can keep going up and down, but your goals remain static. How much Aditi will receive when she turns 25? So I'm doing 2 SIPs for our friends. This 10,000 SIP, which goes for her education. Assuming 12% return she makes on these investments, at the end of her 25th birthday, she receives approximately 2 crores rupees. She can go to Harvard Business School, she can become an entrepreneur, or she can travel across the world. This will be her money. She doesn't have to borrow or take a loan, etc., etc. And if she's brilliant enough, she can pursue higher studies. There's another goal. So I prepared for a marriage. Again, I'm not a big believer of big fat Indian wedding. I want a very simple wedding, but just as a parent, you would like to give some security to your daughter, so that when she goes, wherever she goes, this money can be useful to her for her entire life. I'm saving 10,000 rupees, and at 30, when she gets married, I can gift her this amount, a large amount, so that she becomes financially secure in whichever part of the world she is. This is like Stri Dhan. In older times, as parents, we would give gold to our daughters. Now I don't think gold makes much sense. I think this is the most awesome way to give a gift for long term. Finally, in this market, there may be a lot of people who will be giving you free advice. Okay, and as Nassim Nicholas Taleb says, never ask anyone for their opinion, forecast, or recommendation. Just ask them what they have or don't have in the portfolio. I certainly like this statement from Mr. Taleb. He says, don't just believe anybody. Ask them what are they doing with their money, okay? And you'll get the answer. So this is my family's portfolio, friends, which I just quickly want to share with you. Almost my entire money is going in mutual funds because I believe this is the most transparent way, most liquid way you can invest, okay? You can be anywhere in the world and you have control. So on 21st January 2018, if you see the third chart, my family's portfolio return was 23% per annum for the last 8 years, 2010 to 2018. Now, this was a very phenomenal return, very high return. And, normally you don't get these kind of returns. But at that point of time, when the Sensex was almost very high, the small and mid caps were trading almost very high, my return was this. And fast forward to the, 23rd March, 2 years later, simply, and you see my portfolio returns, it came down to minus 7%. The last row you see, right from 23% to minus 7%. And from a gain of 2 crores, it is now minus 1 crore as we speak on that particular day. So this is how markets can behave from very high to very low, and you can make a lot of money also in the short term, and it can come down also. But you need to have faith. As I said, I'm not really worried whether it is minus 7. I was not very happy when it was 23 also, because my goal is not this returns. My goal is when can I make 100 crores in next 10 years before I turn 50. I want to make my family's portfolio 100 crores and become one idiot. That is why I'm focused on the long-term goal and not on the short-term market movements at all. Okay. And now many of you who have been investing in these equity funds for 5 years, 6 years and seeing negative returns, don't get disheartened. You see my portfolio over the last 10 years, the blue line is the net amount I have invested, and the green line was the portfolio value, which has been over a period of time. So as you can see, for a good time, the green was above the blue line, but because of this market crash, it certainly has come below blue line, and that is why you saw negative thing in my portfolio. This can also happen. Now these times are very, very extraordinary times. You should not take this as usual thing, okay? And that is why you should not worry with this. Finally, Napoleon's definition of a military genius, as he says, the man who can do the average thing when everyone else around him is losing his mind. I've seen most investors start panicking when markets were started to going down 26,000. I think that is the genius. If you can keep your head cool when you know that this money is for long term, you don't need this money right now. You invested in right companies or right mutual funds. Just stay put. Don't do anything. Okay, and this applies to same in investing, especially weeks like this when oil have gone below minus like 30, 40. You have to remain quite sane. So observation from my portfolio is very clear, friends. Our favorite holding period is forever. So my investments are forever. When 23% was there, I didn't withdraw. When minus 7% was there, I'm not withdrawing. And hence it's a very boring game. You don't have to look at your portfolio on a daily basis. The less you look at your portfolio, I'm sure the more you will make returns. Okay. Less churn is more returns. I hardly do any churning in my mutual funds. Okay. I'm a buy and hold investor. I invest for 5, 7, 10 years. Okay. So, less churning. Remember that some funds will perform, some won't. If you have 4, 5, 6 funds in the portfolio, not all funds will perform, not all funds will underperform. Some will perform, some won't perform. Okay, but in the long term, almost the performance comes back if it is a good fund. So don't keep going in and out of the funds. If you're convinced with the idea, then back it up with truckload. Okay, and practice what you preach is what I always believe. It never was my thinking that made the big money for me. It was always my sitting. This was one of the words number one trader at one point of time, Jesse Livermore. He said this, being a trader, imagine he said this, it was not my thinking that made money, it was my sitting. So patience is the biggest virtue in friends, in stock markets and mutual funds. And this was another tweet which says in investing, being active is silver, okay? Being inactive is golden, and being actively inactive is diamond. Okay, so for all of you, the third point, if you've not understood, I've been an actively inactive investor. So I may look at my portfolio on a daily basis or a monthly basis, but I don't do anything with my portfolio for the last 10 years. It's just buy and hold. So this is like diamond, you know that you are sitting on minus 7% loss, but it doesn't matter to you. That is actively being inactive. So final slide, friends, do's and don'ts of investing in these times. This is a good time to invest in a staggered way. Make a strategy to invest at every 5% fall. SIP or STP is the right way if you're investing through mutual funds. Stick to your financial plan goals. That is the number one important thing which you have to follow. Deal with a SEBI registered intermediary only or amphi distributor. Don't fall in the hands of scamsters or somebody who's giving you tips. This is not the time to stop your SIPs, friends. Only if your jobs are in danger or if your salary has gone down. For that reason, I may understand, but otherwise, don't stop your SIPs. Don't redeem your investments if you don't need the money right now. Just because your money has gone down, don't get panicky and don't redeem your. Peter Lynch has said, if you sell in desperation, you always sell cheap. So I don't want you to sell your investments at cheap prices. Don't believe in tips and rumors. Try to avoid the news as much as possible. Don't indulge in market timing. You can never be smarter than the market, right? And finally, don't get into leverage. Don't borrow money to invest in stock market. That can be really dangerous. Three great forces rule the world, friends. No matter how much as human beings we may think we are smart, but world tells us that the world is full of like people who are like either stupid, fear, or greed. These three things always keep playing in our mind, and that is why Benjamin Graham said the investor's chief problem and even his worst enemy is likely to be himself. Okay, because of what Albert Einstein said, because of either fear or greed or stupidity, we somehow are our worst enemies. And that is very important for us to know. Finally, I would like to make a disclaimer before I close up that in this presentation, I've shown my personal examples and the assumptions I've taken are my own. There's no guarantee I'll successfully achieve any or all my financial goals. You're requested to use your own discretion and consult your financial advisor before investing. So please don't copy paste what I just said. So with this, I would like to conclude my session. Thank you so much. And thank you for such a patient hearing. Vasudevan sir, I remain in the timeline mentioned by you, less than an hour. So that we can have more question and answers from the audience. Only one request to the audience is that please don't ask any stock specific question or any mutual fund specific question, any particular mutual fund. And also don't ask me where do you see the markets going, because I have no idea about that. But if you want to ask any fundamental question on investing, I and Ajit sir, Vasudevan sir are more than happy to answer your questions. So with that, we would like to open the session.
Okay, sir. So I will read out the question to you. So the first question which we are having, can we trade mutual fund on BSE, or how can we join that?
Good question. So friends, the word you have used is trading. I would not like to say trade mutual funds. Mutual funds, you should not be trading. You should invest in mutual funds. Yes, you can directly, nowadays SEBI has allowed that stock exchange like BSE. You can open your account directly on BSE Star MF platform. You don't need to go through a broker. You can invest directly in them. So you can go on bsestarmf.com, and there are contact details. You can call them up, or you can do some research, and I'm sure some representative from BSE Star MF would be more than happy to help you and guide on how to go about it. It is completely paperless, my friends. By sitting at your house, even in this lockdown, you can start your first investment there. All you have to do is few documents like PAN card, Aadhaar card, and a cancel check, and in no time this account will be set up.
Okay. The next question which we are having, the person is a CDSL Demat account holder. He want sir to explain about CDSL SMS alert service, which is smart.
For SMS alert, basically the customer has to register himself with his DP, with his mobile number, and there is a form which he has to download, and it can be downloaded from the CDSL website also, or it can be taken from the DP office also. But basically it's like banking, whenever there is a signature is involved of the customer, the bank recognizes the customer with his signature. Similarly, our DPs also recognize our BOs, that is beneficial owners, by signature. So once the SMS for SMS alert, the customer fills up the form and he signs and he gives his updated mobile number. On that number, it will be the service will be initiated by the CDSL and the DP. CDSL has to authorize it and tell the DP that it has been initiated. So that is how this procedure can be done. Ideally, when the new account is opened, there is a provision. You can pick there itself that I want to start SMS alerts. Okay, so then there is no need of filling up any additional form, etc. But if at all any of you have not opted for this service, then still you can go and join this service. As far as these alerts are concerned, for all the debits, in your account, any type of debit, like when you have sold the shares, so through the broker, or if you have transferred it offline, all type of debits will be, SMS will come from CDSL. Even if it is not sent by the broker or your DP, a CDSL will be sending that alert to you. That is one advantage. Second is all the corporate actions, or like your IPO credit or any split or bonus shares, etc. That type of alert for credits also will be sent by CDSL in this SMS alert facility. This is basically for the retail investors, individual investors, and not for the corporates. And I sincerely request all our retail investors to go ahead and use this facility, because it is very useful, to monitor your own account. Thank you.
Thank you, sir. Our next question is, so the person is again a Demat account holder. So he's asking, can I invest in mutual fund MF in Demat form using my CDSL Demat account?
Yeah, in fact, Virendra ji just now answered this, and I believe it is easily possible now. In fact, most of our DPs are offering this service, that like you're buying shares, you can buy mutual funds also, and they can be directly credited in your Demat account. So mutual funds or SIPs or bonds or any other such instruments like ETFs can be bought on the stock market platform once you open your Demat account, and you need not go anywhere else.
So the next question which we are having, Is consulting to the advisor is necessary, or should we buy and sell mutual funds directly through some MF advice platform?
Yeah, so very good question. See, again, the simple answer would I'd like to give you is, if you have time and knowledge to do research on your own, then frankly you don't need an advisor. But if you have any one of the things missing, either time or knowledge, then don't try to experiment with your hard-earned money. Uh, like if you have any fever or any illness, do we really go to Google and try to take medicine ourselves? No, right? We go to a doctor, a qualified doctor. The same thing, you should go to an expert if you don't have any time or knowledge. I've seen a lot of people, making a lot of costliest mistakes while doing on their own, and then later going to the advisor as a result of it. So that would be my suggestion.
Okay, the
Yes, Shivani.
question which we are having, please explain. Manjuri sir, this is question for you. Please explain CDSL easy service again.
Easy service, as I told you, this service can be availed from our website. Customer can log in on our website, and there's a first option on the right hand side, wherein you can log in, and there are certain details which you have to pre-fill. We have to give the information, and uh, as the process, you can see there's a download, easy usable downloads are there, and you can, once you fill up that information, you can log into easy service, my easy. And once you complete that procedure, there is an OTP which will be generated on your mobile. Once you capture that OTP, you will get into our my easy application. Once you enter into that application, in fact, I'm very happy to inform you that we have created one small video also on how to do this type of my easy, how you can use very simply. So anybody interested to know about this facility, we can share this video also. It will be uploaded on YouTube also shortly. However, once you log in into system, you can do everything sitting at your home or from your mobile also. Is an application, mobile application. You can check your holding. You can see your transactions. You can print it also if you want. Last 30 days transaction you can print. Then there are facilities such as I explained in the presentation also. There's a e-locker is there. Therein you can download your important statements, financial statement, financial documents as well as non-financial documents you can download there. So that is an additional benefit once you get into My Easy, right? And then you can upgrade to My easiest facility, wherein you can transfer your shares from the comfort of your home or office. You can transfer it to the broker's account also. So My Easy is a very important, and very user-friendly application which we have developed, and a lot of our investors are taking benefit of that.
Okay. Next question we are having, what exactly is asset allocation? How important it is?
Yeah, asset allocation is the most important part of a personal plan. Basically, it means that based on your goals and your risk appetite, how much money should go into which asset class. So as I told you, if you have emergency funds, which all of us should have, that money has to go into very liquid investment like liquid funds or FD or even cash. Okay, so that asset allocation is purely into cash or liquid funds. If you have long-term goals, then you can decide to invest in equities. If you want to buy a real estate investment, then it becomes some money goes into real estate. You want to buy for your children marriage, then some money goes into gold. Now all these asset class don't move in one direction. So if equity is going, gold may go down. If gold is going up, bonds may come down, because all of this don't have a direct correlation with each other. So some asset class would be making money, some asset class would be losing money, and on the portfolio level you would be having a diversified thing, so you don't have to worry. It's not like your entire 100 rupees is going up or your entire 100 rupees is going down. Some parts will keep moving up, some parts will keep going down. So just like in a thali, no matter how much sweet you may like, your entire thali doesn't consist of sweets, right? You need to have chapatis, rice. You may not like green vegetables, but it is very important for us to have green vegetables also, because every day if you eat junk food, you will know what will happen to your body. The same thing is if you only have very high risky portfolio, someday your portfolio might collapse also. So that is why there is importance of asset allocation. Always practice asset allocation. That is your number one safety gear, I would say.
For next question, we are having the person is CDSL Demat account holder, and the person have done voting through CDSL website. Now he is asking, please explain voting service of CDSL.
Okay. Basically, it's the same thing like if you are having an account with HDFC Bank, okay, you can do all your transactions from the net banking, right? Similarly, they have got mobile application also. So all the transaction which you can do on the internet, net banking can be done from the mobile also. So similarly, whatever e-voting facilities we are giving to our investors for casting their vote on the electronic platform on the laptop or desktop. The same thing if they have downloaded the voting our application on their mobile, they can give they can vote for any resolution, even if they are traveling, if they are mobile, they are not in the home or office, still they can vote. That is the advantage. So one should not miss while voting, because your vote is very very important. So voting is basically it's an additional feature of e-voting, wherein you can still cast your vote even if you are mobile anywhere.
Next question. Recently, one mutual fund was in news for 6 schemes being closed. Are mutual funds safe for retail investors like us?
Yeah. So see, as I said, mutual funds can't give you guaranteed returns. This is very known. Even liquid funds, as safe as liquid funds, can't give in writing that they will give positive returns. Mutual fund at the end of the day is a pass-through vehicle. You invest in mutual funds. Mutual fund managers, in best interest, invest in different securities. So suppose if on your behalf, if mutual fund tomorrow has lent it to Reliance Industries Limited, example I'm just giving you, and Reliance is the largest company in India, and for some reason if Reliance Industries tomorrow default that money, we cannot catch hold mutual fund and say that, look, you give me my money, right? Mutual fund was just a pass-through vehicle. They, on your behalf, they invested in Reliance. So if Reliance defaults tomorrow, so then you will have to be finally be the loser on that. But in mutual funds also there are mutual funds which are very safe. You can always see the portfolio. The portfolio is very transparent. You will know exactly where your money has gone, both in equity funds as well as debt funds. Okay. And as I said, when you invest in debt funds, your main priority should be safety, liquidity, and then returns. But if you are greedy for high returns and you are going and buying high and risky debt funds, then you be prepared for situations like this. Okay, this is not the first time this situation has happened. Of course, the scheme has wound up first time, but in the many other times also in the past also, when ILFS default happened, when DHFL happened, and few mutual funds who had money invested in these, investors have lost money on those bonds. But one good thing with mutual fund is that because your money is in debt fund, and which is a diversified portfolio, the debt fund also invests in 40-50 different companies. So even if one company has defaulted within that portfolio, your other portfolio is quite safe, and that helps you. So do your homework, as I said, or go to an advisor, SEBI registered advisor, and based on your risk profile, you should choose your mutual funds.
So next question we are having for Manjude sir. Please explain about CDSL Consolidated Account Statement service again.
It is called as e-cash. It's a very good facility. Again, wherein you get consolidated statement for your shares as well as your mutual funds. And assuming you are having a first account open with CDSL, and then you have opened another account with other depository, you will be able to see both accounts statement in that consolidated account statement. And since your first account is open with CDSL, CDSL by default will be sending you this statement. Now, as far as mutual funds are concerned, even if they are in physical form or in demat form, all the mutual funds from various RTAs we get the data, and that the details of your mutual fund units also are visible in this CAS, consultant account statement. So it's a very useful facility wherein clients can get this statement. Ideally, this is 6 monthly. It is given to the clients, not every month. But if in case you are having any SIP on a particular scheme, then every month the valuation will change for your mutual fund scheme. So in that case, the cash also will be generated every month for you. So one advice can be to the retail investor that if they have one SIP at least, then they can get their e-cash on the monthly basis also. I hope this satisfies the question.
Okay, thank you, sir. Next question. What are the balance advantage funds? Are they are suitable in current market condition, and how much return can we expect?
Very good question. Balance advantage funds, as we say, are all weather funds. If for those investors who don't know which fund to go for, and don't know how to time the market, when to enter the market, when to exit the market, balance advantage funds are very good. These are called asset allocation funds, which means they would invest in a mix of equity and debt. If markets are very high, they would have less of equity. If markets are very low, they would have high of equity. So they would keep buying and selling equity based on the market levels, which means as retail investors, we don't need to time it. We can just enter at any point of time. So suppose, when you would have entered when the stock market was at 26,000 Sensex, most of these funds would have 60-70% equity exposure and only 20% debt exposure. Now that market has gone up by 20%, most of these mutual funds would have come from 80 to 60% as equity exposure, and the remaining 40 has gone into debt. So they do auto balancing, which means you and me can just sit back and relax. It's like an autopilot car. The car is being driven automatically. You have to just sit and you'll be fine. So this is the future trend. Lot of retail investors are wanting to go for these kind of funds. So, and most mutual funds have balance advantage funds in their portfolio. So you can check them out on many websites and take a decision for yourself.
Next question. What is the core and satellite approach to mutual fund investing?
Again, a very fantastic question. Core and satellite approach means, see, so suppose if you have 100 rupees, the core part of the money, which is like 60, 70, 80% of that money, should be strategic long-term investments. Okay, you should not be playing with this money. This is very important money for you. This is meant for your long-term goals. You can't go wrong with this money. But there may be 10-20% satellite approach you can take, which means this money you can want to play with this. You can take a short-term tactical calls. Like you can play in direct stocks also if you think, okay, this is a good time to make money in direct stocks or high risky investments. And you should be prepared that even if my calls go wrong, my investment calls go wrong, I'm not majorly impacted because my larger portfolio, which is my core portfolio, is safe. And that is so your short-term goals should not be tagged to the satellite portfolio. Satellite portfolio is, again, as I said, it's a money which even if you lose money tomorrow, you are not that much impacted.
Next question we are having. The person wants to invest for 10 years for long term. So he's asking, can he invest full 100% in mid cap or small cap funds?
See, again, a very good question. See, most of the people who come to me and ask that, I want to invest for 10 years, I'm a long-term investor, and, they say I can take risky. And, based on the past returns, they find mid-cap and small-cap fund give very good returns. Okay, so when you've not invested your money, it feels very easy. You feel very easy, okay? But once your money is invested and then the market goes down by 20-30%, the same investor gets very worried because now he's seeing statement where his money has gone down by 30%. That's what I want to tell the investor, that if you have not invested earlier, then don't come with this kind of approach. Start with conservative funds like multi-cap funds, large and mid-cap. Only when you have got experience over a period of time and you know yourself that you don't get panic in such kind of situations, is when you can start allocating some money to mid and small cap funds. But if this is your first investment, my friend, then don't start with this. This can be very risky and can backfire also.
Okay, thank you. So next question, someone is requesting you to advise some good website for doing mutual fund research.
Okay, very good again. So there are a lot of websites out there, in the market. There is one Morningstar also, where actually Morningstar is tied up with BSE also. So, and it's a free website. You can get a lot of research for on mutual funds on the Morningstar.in. That is there. Value Research is another website. Money Control is there, and there are many other websites which are free. There are ones which are paid also. So there is one one website called Prime Investor, which is like paid website. So Money Life is another very important website. So if you just do Google search, you'll find a lot of them. You can subscribe to their blogs, and if you like their articles and like their research, there are paid subscriptions as well. And based on your liking, you can go for the paid subscription as well.
Next question, how do we do periodic review of mutual fund in which I have invested?
Yeah, so more than periodic review, I always recommend investors before they invest money, they should spend a lot of time in understanding where the money is going, which scheme they're going to put. That they should do a serious review before putting the money. Of course, once you put your money, then maybe 6 monthly once on a Sunday morning, 1 hour, you can just review your portfolio. You can review the fund holdings, where the fund has put your money. Is the fund performance in line? Are they able to beat the benchmark? How is their ranking? And again, all these parameters you can find on either the respective mutual fund website or Morningstar Value Research, such kind of websites. Or if you're having your advisor, you can have this conversation with your advisor too. In 90% of the cases, friends, if you've chosen right scheme for your goal and based on your risk profile, you may not have to change the funds every 6 months, 12 months. Okay. But you can just review, and you may do nothing also. That is even fine. But you should be aware of what's happening in your portfolio. So even if the market has gone down by 30%, how is your portfolio looking like? But that doesn't mean that because markets have gone down by 30%, you have to do something in your portfolio. That may be absolutely wrong. If your goals are long term, if your fund selection is right, and you're not majorly impacted, then just be there. That's completely fine.
And next question, best book you recommend for investment advisor?
Okay, so the best book for investors, there are many books for investors which I would recommend. If you want very commonsensical book on investing, there's one book written by Monica Hullen. She is a financial journalist in India, very well known, very followed. She's written a book called Let's Talk Money. That's in a very simple language. It's written. It's for common investors out there. So to begin with, that's one book you should definitely go for. The other international books are like, One Up on Wall Street by Peter Lynch is another good book for serious investors who want to put money in direct stocks. I think that is a book you can look forward to.
Next question, can retail investor buy index fund?
Yes, of course. In fact, I normally recommend that if you're starting your first investment in mutual fund and an equity fund, in fact, index fund is a good way to start. And particularly if you're not taking help of any advisor, then index funds are no-brainers, because there you cannot go wrong, because you're buying the market, and as index goes up, your money will go up. So that's a good place to begin with. And then over a period of time, if you want to add other active funds, you can go into other funds as well.
Next question, what are the things to check while selecting the mutual fund, like PE ratio, return for 1 year, or company portfolio?
Again, a brilliant question, friends. So there are no one or two variables. There's no definitive answer. What may work for me may not work for you. But some of the things which you should check is the track record of the mutual fund. How long has been the mutual fund there in the market? How long has been the fund manager who is managing this portfolio been managing this fund? Okay, what has been his long-term track record? Which means in bull markets, how has the fund performed compared to benchmark? In bear markets like this, how is the fund performed? Is the portfolio too concentrated or too diversified? What is the expense ratio of the fund? Okay, and P ratio and other ratios are also there. Okay, size of the fund also plays an important role. So all this information you can find on the mutual fund website or in many other third-party websites which I mentioned earlier. So over a period of time, you'll be able to fine-tune your research. But I think good ways to begin with this, what I just said.
Okay, next question. Is it good strategy to go for companies which has consistently given high dividend? Many a time they do not give capital appreciation.
Wow, very, very good question again. See, again, dividend is again one of the parameters you should look while investing into a stock. It is not the main parameter. The main parameter always has to be how is the company, in which industry the company is in, is the company able to generate regular profits, good margins, have they good margins, and is it sustainable over the longer term? What kind of competition it has? Again, the third important variable is the management. Who are the people who are running it? Okay, if the management is good, then you don't have to worry again. And finally, the fourth thing you have to look at is the price at which you're investing. Every company is good at a particular price. Okay, so it's a mix of all these 4 or 5 factors. Dividend again should be one of the factors and not the main factor in investing.
Next question. How much money we should invest in equity right now and how much we should hold on? Let's say if we have 100 rupees.
See, this answer will be different for different people. There can't be one answer for this. It all depends on your risk appetite, as I mentioned. It depends on your long-term goals, and many other things. So, you have to first make a financial plan, and then only you will be able to answer what is the right kind of asset allocation you should have. So I cannot go in much detail right now because this won't help many other listeners out there.
Okay. In reference to the PE example given in presentation, currently market is trading at 19 to 20 p.m. Since PE is the indicator based on earning of past 12 months in current situations where the future earnings seems to be very pessimistic, is PE can be good indicator?
Yeah, so P can be, as I mentioned in my talk earlier, P is one of the indicators, and one should not rely solely on this to determine whether the market is cheap, expensive. There are many other parameters like market cap to GDP ratio, market to P by B ratio, market to price book. So there are many other such parameters. You should look all of them together and then see whether the market is cheap or expensive. Because earnings has been quite bad and earnings can be quite volatile also. So this ratio may change very rapidly in no time. I completely agree with you that this cannot be completely relied on, but this is a good start. I think a lot of companies, a lot of mutual funds follow this ratio very actively. So, and this has been quite popular for a long time. So this certainly has some history to it.
Next question. Should we invest in multiple ELSS or one or two and lump sum versus SIP in ELSS?
Yeah, so since ELSS is your annual thing, into for your tax saving, I would believe if you're a salaried investor and you get your monthly regular income, SIP is the best way to invest in ELSS. For example, I've been doing my SIP in ELSS for the last 10 years, and I can tell you, even after this crisis, my 10-year returns in my SIP is almost 10%, 10.5%, 10-year returns. It's not bad. So SIP is the better way to go. Just stick to one or at the maximum two funds. As I said, in the long term, the more funds you have, it's not good. Actually, it's worse. If you have too many funds in your portfolio, it doesn't really do help. Stick to one or two funds, and you should be doing well over the long term.
Okay. Shares held in Demat account with DP are finally held with CDSL/NSDL, so no risk of falling, no risk of DP falling. So person is asking, please confirm.
Can you repeat the question?
Sure. Shares held in Demat account with DP are finally held with CDSL NSDL, so no risk of DP falling. Please confirm.
Basically, I would like to clear here that whether your account is with CDSL or NSDL, your shares are absolutely safe with the depository. They are not with the DP. So this one should understand. And even if something happens to the DP, you need not worry. That something will happen to your shares. However, you have to only ensure that the shares are lying in your demat account with the depository. Okay, and that you can check from the application which you have prepared, like MyEasy, wherein you can always check your statement during the day, any 24/7, anytime you can check whatever shares you have purchased. On T+2 basis, the shares come in your demat account once you buy it from the broker. So you have to ensure that the shares come in your demat account. Once they come in the demat account, whether it is CDSL or NSDL, that doesn't matter. Both the places they are absolutely safe. Okay, but then you have to monitor your account periodically, just on the safer side.
Next question: how to invest in foreign mutual funds?
So foreign mutual funds, many of these mutual funds have now foreign funds. Of course, most of them have US based funds. So either they can be index funds in the respective country, or they can be active funds, or they can be fund of funds, which means one mutual fund in India investing in the other mutual fund of that country. So that's called fund of fund group. So almost all mutual funds have funds, international funds. Again, just check out Morningstar website or Value Research. You'll find entire list of these funds. You can see the entire holdings also. You can see the track record. And as a retail investor, you can do SIPs, you can do lump sum, you can do online also, again through the platform, the Star platform. So it is quite easy today. As I suggested earlier, around 10 to 15, 20% of the money you can invest in international funds. But please do your homework very well, or consult your advisor before investing.
Next question: SIP should be done in mid-cap stocks or small-cap stocks?
See, in stocks, I would not recommend SIP to do, because again, you don't, if you've not done the research, okay, and you have no idea, then it can be very risky and it can backfire. In fact, I wouldn't even recommend investors to do SIP in mid and small cap funds unless you have been a very experienced investor for a long time in the market. You've been in mutual funds for the last 5-10 years. You've seen similar kind of falls, and your time frame is much longer. Because frankly speaking, I've seen many people when they've lost 30%, 40%, then they exit these funds at the wrong time and never to come back. So my advice to most of you is that don't be greedy. As I told you earlier, Albert Einstein said, most human beings are either stupid, stupidity drives them, or greed or fear. So just invest your money in multi-cap funds or large and mid-cap. I think let the fund manager do the job, and he'll do it well.
Next question: how many demat account can one have?
Really, one can open as many demat accounts he wants. There is no restriction on that. However, you may be aware that there is some charge which is payable. It is called as AMC, annual maintenance charge, which customer has to pay for every demat account which he opens. So there is no need basically for any investor to open multiple demat accounts. 1 or 2 demat accounts at the most are sufficient.
Next question: so many brokers are defaulting nowadays. How can we take care before selecting right and proper broker?
Vasudevan sir. Hello. Vasudevan sir, is he there? Okay.
Yeah. Actually, I can brief this on this. There is you can check the website of BSE. You can check the website where you can get the number of complaints, etc. The details of number of complaints, etc. You can check that. However, there is no hard and fast rule as such to for this purpose. But you can check, you can get idea from that where to, from which broker you can select.
See, you have to verify the BSE NSE websites also regularly, no, about the broker's performance and all. Okay. So you'll have to see because of the current market scenario, no, what is happening every day. There is a lot of fluctuation. So you have to be very careful in that. You have to carefully, you have to select, and carefully you have to observe also about the broker's position in the market. Okay. Next question. Shivani, can you hear?
Yes, sir. Yes, sir. Yes, sir.
Yeah.
Okay, so the next question is, the person is having two demat accounts in CDSL, but when he log in on the mobile app, only one demat balance is visible.
Ajit,
One demat account balance only is visible.
Yeah.
visible on the mobile.
Okay. This I'll have to find out why that customer has to approach us, and we'll have to check what exactly has it's hidden by
Maybe,
him.
so maybe other account may not be having any balance, no, so you may not display.
No.
No, so it may not be
Maybe
having the balance.
for every account he will be getting a different login, ID and password from the different DP. It cannot come into one. Suppose he's having an account with say Sher Khan or Indian Line in other account. So both the DPs will give the different ID.
So next question, why we cannot invest in mutual fund through BSE star MF using a debit card?
So I think, in fact, that is already, in fact, work in progress, because in many mutual funds or website nowadays, you can invest in debit card. You can use even in BSE also, but even I would suggest a better way of investing than even a debit card, because even in debit card, it requires 2-3 steps. Nowadays, there is something called one-time mandate. So if you register one-time mandate, when you sign up for the account, and you can decide what amount you would like to register for. You can go up to a 1 crore rupees also. So which means next time if you have to invest money, simply you have to just select that OTM mandate, and based on that you can invest it straight away. There are no 2, 3, 4 steps after that, So that is quite safe, and get alert on your mobile also. And that is what most investors are using these days. So I would, and even in debit card you may have a restriction like 2 lakh, 1 lakh, but in OTM, as I said, you can go up to 1 crore. So this is even a far better and advanced version compared to any other mode of payment. Even in net banking, you have to it will be redirecting to your banking website. What if your banking website is not working or having some problem? In debit card, I've also seen that sometimes it shows that the payment has been debited, but money has not been received by mutual fund. There is some error. If your website is slow, then there could be error in the transmission, transfer. So all these have problems. So I would encourage go for this one-time mandate, which is far more easier and investor friendly.
Next question, can you give advice on stock lending and borrowing?
I don't have much idea on this.
Yogesh, Yogesh can give. Yogesh, stock lending and borrowing, SLB.
Yeah, SLB is available. SLB is available, which you can that is stock lending and borrowing mechanism that is available on the exchange, and you can lend your shares in short, and you can get basically money for that. So that this facility is available. You can approach your broker actually for this purpose, and you have to lend your shares actually.
So in the SEBI, in the BSE India website, all the details are there. How it has to be performed, no? What are the parameters and how to take the benefit of the SLB platform? What are the necessary steps involved in that? All are explaining the SLB part in the BSE India website under the ICCL, no? The clearing corporation.
Next question. What are the chances for hacking of e-locker?
I think very interesting question, but the answer for that is for several years, CDSL from 1999, because of the security measures which we are following, our database is very secured, and we have got all the certifications from Indian as well as international bodies, wherein the data of the crores of rupees worth data of the shares is very safe with us. So there is no possibility that this can be hacked. Okay, so that with that guarantee only government or SEBI has given us this task, of holding securities of various natures of the customers in our custody. So there is one should not fear that it can be hacked or it can be used for any inappropriate purposes.
Next question. Kindly explain inter and intra depository security transfer process. Can I transfer securities by my own through online mode?
Can you repeat the question, the first part?
Yeah. Please explain inter and intra depository security transfer process. Can I transfer my own through online mode?
Yes, as I told you, under easiest facility, if you are whatever demat accounts you have, we have got a facility to transfer your shares from your one account to another account. Only thing you have to define accounts. You have to define these accounts in the system, and you can do it very easily online from your laptop or desktop from anywhere. It is possible intraday from one account to another account.
Okay, so the next question is for Vasudevan sir. Why is there
Yeah.
decline in equity investor?
Because of the current market situation, no people because of this, people don't want to take any risk, so that is why they are switching on to the mutual fund route. If you see, even in spite of all this downfall, the SIP investment is always maintained, even for the month of March also. So people are now understanding, better switch over from direct equity investment to mutual fund route. Because if you want to invest in equity, you should have that particular knowledge. Not only knowledge, you should have time to analyze all the stocks where you are investing. So see, it's like 9 to 5 job, no? It's a 9 to 3:30 job if you start investing in the equity market. Suppose I invest some X company, then I have to see market, what is happening today to the company, what is the demand now, what is the today quarterly result, what will happen. So you should have, it's a full-time job, which normally we don't have. So that is why we suggested to go to the mutual fund route. Okay. So that is why the people now understood, after the lot of effort put in by the exchanges, SEBI, AMFI and all. If you don't have time, don't invest in mutual fund. Equity direct market. So they are switching over to mutual fund. Okay. So naturally, the investor will increase in the case of mutual fund investment. Okay.
Next question. What is asset allocator fund?
Okay, so asset allocator fund is one category of fund in a mutual fund where it can go beyond debt and equity. So it can take gold as another asset class. Right now we have only gold as another asset class in India. Tomorrow, for some reason, if SEBI allows real estate or currency also, so they can have a mixed portfolio. So which means the fund house decide on what is the right asset allocation, for an investor. So right now we have asset allocation funds in the country, asset allocator, where they have these three asset classes between gold, equity, and debt. They can choose. So this is to just give diversification to investors. So again, many investors who don't know how much proportion to put in equity, how much to put in debt, and how much to put in gold, they can simply go into this kind of fund where they have a standard asset allocation, and they don't have to do auto balancing on a regular basis.
Next question. PMS of mutual fund. What should we select and how to judge?
See, PMS and mutual funds are in a way similar thing, but yet different also. Similar thing because they may invest into the same kind of asset classes and they may have a similar portfolio. But normally PMS we have seen is for investors who have high capital. The minimum amount as laid by SEBI is 50 lakhs rupees. So you need to be a high net worth individual. And secondly, there it can be a little more customized portfolio compared to mutual funds. There the portfolios can be high risk, high return. It will have lesser concentration also. In PMS you can go for something like performance fees, wherein only if you make certain returns mutual funds will the PMS player will charge you fees. So a lot of customization is possible in PMS, which is not possible in mutual fund. Mutual fund are more standardized vehicles. So just to give you a crude example, mutual funds are like your buses, standard buses, the government buses which is there plying on the roads, and PMS is like your personal cars. You can exit, you can enter any point of time, you can take whatever route you want to take, you can drive faster. Okay, so that is how it is there. So always remember, it is little high risk. People want to go to earn high returns, and hence they have to take high risk also. So choose based on what is your long-term goal, your risk appetite, and then choose the right vehicle.
Next question. How to know about the fund managers who manage the funds and their methodologies?
Very good question. Again, so most of these fund managers, so again, Morningstar has a section on fund managers where they do a lot of research on fund managers, the qualitative research, on how the mutual fund managers have taken bets in the past, what is their style, what is their philosophy, and then you can track their philosophy based on the stocks they buy and sell over a period of time, and then you can realize whether they are following the strategy or not. So this is not an easy exercise because it's not quantitative measures, it's more qualitative. So you have to observe this for a period of time and then fine tune your selection accordingly. But this is a good way to know the style of the fund manager and then choose portfolios accordingly.
Next question. Can we decide mutual fund scheme investment based on rating by credit rating company?
Again, credit rating agencies' ratings are only one of the factors. They may not be necessarily right all the time. It just gives you an indication. Finally, a lot more work you have to do beyond just credit ratings. So, in the last 2 years, many of these credit rating agencies themselves have gone wrong. So don't just go blindly by what they say. Again, as I tell you in debt funds, debt funds try to be as simple as possible. The return difference between one very risky debt fund and one very safe debt fund can be not more than 2%. So if a safe debt fund gives you 6%, the very high risky debt fund can give you 8% at the maximum. For that 2% extra, why takes such a high risk where your entire capital is at stake in a way? If you want to take risk, as I always say, go for equity funds for that part of the capital. So keep things simple, and it will serve you quite well, more in these times.
Next question. Can we set our MF SIP to be invested only when the market is bearish?
Wow. So yeah, few mutual funds have variation of SIPs which is called smart SIPs, or other names are also there, where if markets are down, then a higher amount of SIP goes in that month. If markets are up, then lower amount of SIP goes. But again, the only challenge which can come is whether do you have that kind of balance in the bank account. So let's say right now when the markets are down and your salary is also down by 50%, and in this month the mutual fund decided to take 3 times more than your usual SIP because the markets are down, you may not have that money, and every month a new figure will see in your bank account, right? A new debit will come. So this again can have problems. Again, I always believe, in the longer term, just keep things simple. If you do even plain SIP for a long term, I think you will make decent returns, 12, 13, 14. By doing that smart SIP, you may earn 1% extra return over a long period. But imagine the kind of hassles you'll have to go through and the inconsistencies, which I think is not worth. See, at the end of the day, investing has also to be a very peaceful activity, right? Where you're not bothered on day to day what's going on. So the more simpler you keep the things, the more you can focus on your work, your competence, and let your money work harder for you.
Next question. Index ETFs are better or actively managed diversified mutual funds? And passive investing is better or active investing, especially in India?
Again, you will get different answers compared to, based on the people you speak to. The best way is to find for yourself. So I would normally recommend if you think index investing is good, buy some index funds in your fund, and then do some equity funds also, and then track it over a 3-5 year period. As far as 3-4 years, index have beaten active funds. Most active funds have not been able to beat index funds over the last 3-4 years. But I think it is too early right now. I still personally feel at least in next 5, 7, 10 years, active funds do stand a chance. Not all active funds, but let's say multi-cap funds or large and mid-cap funds, they still stand a chance. But going forward, we will also align to how the developed markets are, like US markets and European markets. In US markets, today most active funds are underperforming the index. So I think a time will come in India when in 10, 15, 20 years, we will also underperform it. So I personally feel today also active funds can beat it. But if you want to try for yourself, do a 50-50 portfolio and observe for yourself. I think this is a good thing to go about.
Next question. What one should do when ELSS is negative? Exit, increase SIP, or stay invested with lower SIP?
See, again, if you're doing SIPs, then I would not recommend to stop your SIPs or just because the markets are down. In fact, when markets are down, you should be increasing your SIPs because you'll be buying higher units at that point of time. Second example is that if you don't need the funds, then why exit right now? Of course, you may exit if the fund has performed quite badly compared to other participants in the market, other fund houses, and and it has been underperforming for a long time. In that case, you may want to switch to another ELSS fund. That I agree with you, but for that also you should wait for 3 years and observe it before taking such action. In last 6 months only, if your fund is underperformed, it doesn't make sense. You have to give some time to the fund manager to come back. So 2 to 3 years you should observe and then take a call.
Next question. Can you elaborate why not more than 2 ELSs?
See, when you invest in mutual fund, the beauty is diversification, right? In one mutual fund, when you invest, your money goes into 40, 50 different companies. Now, imagine if you've invested in two mutual funds, then that mutual fund would also have put in money in 50, 60 companies. Just to give you a perspective, 90% of the Indian funds in India, 90% of the money goes into top 140 companies of India, okay, on the BSE exchange, what you see, because that is where the highest amount of liquidity is. So if both the funds are investing in similar set of companies, and if 60-70% of the portfolio is looking very similar, then the more the funds you have, it is only creating more confusion. You are only buying the entire market. And as somebody said, if you buy the entire market, right, then how you will beat the market? It is difficult. And so if you want, and in any case, if you wanted to buy the entire market, then go for index fund only. Why go for active funds? At least you will save cost there. So less is more in mutual funds, as we say. 1 or 2 mutual funds which you can track, which you have done your research very carefully, and if you invest for longer term, I think will give you far better outcome than having 20 different funds in your portfolio and not knowing what each one of them have a role in your portfolio.
Next question. Is there any limit on return to AIF investors?
AIFs are nothing but alternative investment funds. These are again for very high, professional investors. The minimum amount to invest in AIF is 1 crore. I would not encourage retail investors to even think about it. It doesn't make sense. Only for ultra HNI investors, high net worth, it can make sense. They have different strategies which can be very safe, very risky, and they're customized solutions for these category of people. So for most retail investors, it is better to be avoiding these kind of vehicles.
Next question. How much is the AMC charges on CDSL Demat account?
Again, good question. But these AMC charges are different as per the DP's tariff, which is available on the DP's website. So one can compare, the charges if that is the criteria for opening the Demat account. So charges can be different with different DPs.
Next question. How to find out my risk profile?
Wow. So you go to a theme park as in world. How do you find out whether these rides are good for you or not? So see, many of these things are logical, but nowadays you can go online and there are, if you just type risk profiling questionnaire on many websites, you'll find different kind of risk profile. Try attempting 2 or 3 risk profile questionnaires. They're very much similar. And when you answer those questions, you will get a score, and that score will determine how much risk appetite you have. Okay. My only suggestion is that when you answer these questions, be honest to yourself. See, this is not a test you are giving to get higher marks. Okay. There's no competition here. You don't have to get the best risk profile, and there's nothing called best risk profile. Again, each person, within the same house. So be true to yourself, be very transparent, answer your question honestly, and you'll get your risk profile. The other thing also happens is that your risk profile can also change from time to time. So today, while you've entered markets, your risk profile may be conservative, but over a period of time, you have learned more about markets. By attending such kind of seminars, by reading books, you become more intelligent, you've got more wisdom, and over a period of time, you'll find that your risk profile has changed. Which can also happen. So good idea to do this exercise once in a year to know where do you stand.
Next question. I want to open account in BSE Star MF. How to do?
How to?
So the best way. Vasudevan sir, you would like to take this?
No, what is the question? How to?
How to do it?
How to become the member of the Star Mutual Fund platform?
Yes, sir. That is the question.
So that BSE website all are beautifully explained, So that we will probably we will reply through the email to him. Okay. Okay. The BSE website, that's a mutual fund platform. All are explained along with the contact number and all. That we will reply through email to him. Okay. Please go to the next question.
The person wants to convert his LIC policy to Demat account. Is it possible? Please advise.
Ajit, are you
Good
doing
question.
now LIC policy? Huh?
Yeah, question. Some time back, LIC has permitted to demat their policies, but I believe as of now it is not happening. Only private insurance companies are supporting CDSL. So any other policy of some other insurance company, it can be taken directly in electronic form, as I explained earlier.
The next question is, who is top 5 PMS for equities?
This is actually, there's very difficult answer for this. Are you talking about top 5 based on the performance, which can anyway change from month to month, year to year? Are you talking about top 5 based on sizes? I think for size, you can check out the SEBI website where they mention the information. But all I want to tell you is, this top 5 may not give you the right picture also. Okay, because what is a parameter for top 5 can be completely different. If you want to invest in PMS schemes, you should understand what is that PMS scheme all about, what are the features, what are the risk, terms and conditions. Understand that very carefully and see if that is in alignment with what you're thinking. Then only go ahead with PMS.
I think that was the last question for us.
Thank you. Thank you, Shivani. Yogesh.
Thank you.
Yogesh.
Thank you. Thank you. Thank you,
Please take
Gajendra
vote
ji.
of thanks. No?
Thank you, Gajendra ji, uh, thought-provoking seminar, and thank you, Mr. Ajit Manjure ji, also for your session. Thank you very much, and I thank all the
Investor.
participants for the seminar, attending the seminar. Thank you.
Having a lot of patience. Thanks you, Gajendra Kothari. Thanks a lot for sparing such a long time and very patiently answering all the questions. Thank you. Thank you. Thanks a lot. Thank you, Shivani,
Yogesh.
for coordinating this. Thank you. Thank you.
sir.
Thank you, Shivani. Thank you. All the best. Let us see next week. We may plan something. Let us see. Thank you. Thank you,
you, sir.
Kothari. Thank you, Ajit. Thank you.
Okay, sir. We'll keep meeting via webinars now.
Yeah. That's the way things happening like that only. Let us see how things shape up on third. Thank you.
Yeah, instead of ground events, we'll have to continue webinars only now.
Yeah. That is how it's happening. The way things happening, maybe a month or two we have to do like this. Thank you.
Yeah.
Hello. Thank you,
Thank you.
Ajit. Thank you. Thank you.
Yes,
Thank you,
sir.
Kothari. Thank you.
Thank you.
Thank you. Thank you, Yogesh. Thank you.
Yeah.
Thank you.